so the results in this webinar are represented in US dollars as well, unless addressed otherwise. Although we will keep things fairly high level on this call, our website address is listed here as well, where you can download our full financials. So with that, I'll turn it over to Paul to start by discussing our Q3 income statement and balance sheet.
Thanks, Nick. As Nick mentioned, I will start by highlighting a few key areas of our income statement and balance sheet for Q3 and the first 9 months of 2020. On this slide, we show the full income statement as seen in our financials. The key points to highlight on our income statement are as follows. First, starting with our top line, year over year, our continuing revenue grew 35% in the first 9 months of 2020, after adjusting for the EPC services business, which has been exited. With our strong backlog, we are looking forward to revenue growth accelerating into 2021 and beyond. Second, our first 2 self-finance projects became operational in Q3, which will become a regular occurrence going forward as we build our base of operating assets and recurring revenues. Already in Q4, we have reached commercial operation on 2 additional projects. In future quarters, we plan to split out our recurring revenue on our income statement. Our gross margins continue to be strong. For the first 9 months of 2020, they have averaged 48%. Even after adjusting for one-time events, we are above the 30% level. In Q3, we also recognized a gain of settlement of debt from our exited subsidiary, which was noted as a subsequent event in our Q2s. That gain of over 1.1 million helped drive positive net income in the quarter of roughly 600,000. Next, we will take a look at our balance sheet, which improved significantly in Q3 as we settled debt, received proceeds from exercise of warrants, and reached commercial operation in 2 projects. In total, our Q3 balance sheet saw a working capital improvement of over 1.3 million compared with our Q2s. In addition, within Q4, we should see another gain from winding down of the EBC services subsidiary. The court will actually review our proposal tomorrow on November 25th.
Thanks, Paul. Our backlog continues to be one of our biggest highlights this year, and that growth continued in Q3. By September 30th, our backlog had grown to 112 million, compared with 83 million at the end of Q2 and 30 million at the beginning of the year. That included 62 megawatts across 50 projects, up from 52 megawatts at the end of Q2. That growth is after accounting for 2 completed projects, which moved out of the backlog and are now shown as solar assets on our balance sheet. We forecast that the backlog will take 2 years to build out, and once operational, will generate almost 11 million in annual recurring revenue over the project's lifetimes, which average about 25 years. Our development team is as busy as ever. We now have a pipeline of more than 250 million, which represents the net present value of additional projects outside of our backlog. We get a lot of questions about our project backlog, so we thought we would take a look at a few more angles today to provide more clarity. First, we wanted to talk about the project lifecycle. In this sector, we often break a project down into 3 phases, as shown here. First is the development stage. Here, the project is not yet ready for construction, but rather we are preparing it for construction, working through such items as grid interconnection. Second is construction, or what we refer to as deployment. This is where the project gets built. And third is operation. This is when the project enters operation and starts to produce energy revenue, continuing onward for the life of the project, usually at least 25 years. We also have terms for the milestones that separate each stage. The first is notice to proceed, or NTP, when a project is ready to start construction, and the second is commercial operation date, or COD, when it begins to generate energy. With that in mind, we want to clarify a few items. The first one relates to when revenue is earned. Before winding down our EPC services business unit, we earn most of our revenue by building projects. In other words, we are paid as we completed the middle step shown here, which is deployment. On the other hand, as we self-finance projects, we shift our lens to the operational stage and earn our revenue over the project lifetime. In terms of why this is more valuable, as a developer, you own the project and capture far more value than simply being hired by a developer to build it. With that in mind, let's take another look at the backlog value, which you can see summarized here. With this total backlog value of 112 million what it represents, is the calculated net present value of the projects we are developing and building at the start of operation, or that COD date. We model the financial performance of the project over time and discount that back to time 0 at a discount rate of 10% for projects in the US, taking into account all the costs of operating the project over time after that commercial operation date. First, though, those projects need to be built, which touches on the last point we want to discuss. During the development phase, UGE is making an initial investment to get that project ready for construction. Our rule of thumb is about 2 cents on the dollar. In other words, for $1 million of backlog, we expect to invest somewhere around $20,000 developing the project. However, once we get to the deployment phase, we have lined up project financing in order to fund the project costs. Our finance team lines up funding in order to pay our deployment team for the work completed in bringing that project into operation. Such financing is primarily project leverage, as well as monetization of incentives where that's applicable. In other words, our model is specifically designed so that cash equity contribution isn't necessary. Rather, the build-out of the project is a cash flow positive endeavor as we work with our capital partners to fund project deployment. And I just want to repeat that one point. Deploying the backlog is a cash flow positive phase for the company. It does not require a capital contribution from the company. That said, from an accounting perspective, during this stage, we are not yet recognizing revenue. Instead, that cost of building out the project is seen as construction in progress and unbilled revenue on our balance sheet. Next, though, when we get to that point of COD, the project commences operation and begins to generate energy revenue. The projects at this point are shown as solar assets on our balance sheet and generate recurring revenue on our income statement from here onward. We realize there's a lot of detail in here, and we're really only skimming the surface. So please feel free to submit any clarification questions, and we'll do our best to get to them during the Q&A. And of course, feel free to reach out to us offline as well. With that, I'll turn it back over to Paul to talk about subsequent events.
Thanks, Nick. Subsequent to the close of the quarter, we had 3 subsequent events that we want to quickly highlight. First was the sale of a project announced last week. Though we intend to hold the vast majority of our self-developed projects, selectively we can make the decision to sell a project or projects, adding non-dilutive capital to the balance sheet. This NYC area project was sold for roughly $700,000. Second, we have continued to see warrants and options exercised, and in the past week we have received proceeds of roughly $200,000, further bolstering our cash position. And third, we announced 3 new projects in New York City, adding an additional $3 million to our backlog.
Thanks, Paul. With that, we'll wrap up the prepared remarks by pointing you to where you can find more information. As mentioned earlier, our website is regularly updated and contains all of our financial filings and other updates. You can also visit Sophic Capital's website for additional information. You can also follow us on Twitter to get links to announcements and other media. Thanks again for tuning in today. Marcel, back to you.
Thank you, Nick. We've collected the questions investors have submitted via email since issuing the financial results this morning. We have also collected the questions submitted through the web portal's Q&A tab during management's prepared remarks. We'd like to thank participants for sending us your questions, and you can continue submitting questions through the Q&A tab at the top left-hand side of the web portal. So let's move to our first question. What are UGE's milestones for the next 2 years?
Yeah, thanks, Marcel. I'll take that. So in terms of the next 2 years, maybe as I reflect a little bit on 2020, I know at the beginning of this year, one of our main goals was having cleaned up the focus of the company after exiting the EPC services company. We were really focused on the develop, build, own, operate model that we put in place, and we wanted to get our backlog up to 50 million. And of course, we've far exceeded that. And kudos to the team for all the hard work they've done this year. As we look forward over the next 2 years, we're first and foremost really focused on the execution, through the deployment of these projects first and foremost, and then of course building up the additional backlog to have the next phase of projects thereafter. I think that we're really just scratching the surface is how we feel. I think that throughout the regions that we operate in, I think market penetration in many of those markets is sub 1%, and probably across the average, it's only in that sort of 1% range. So we think that there's going to be a really good decade of activity here for us and for our sector. So we're going to really focus on that execution, building up that asset base and the base of recurring revenue, but then also providing line of sight to additional backlog growth to see us reach even higher levels thereafter.
The next question is, what do you have to do to win bigger deals?
That's a good question. I think that if you tracked over the history of the company, going back as far as 10 or 11 years ago when we started the company, at that point in time, our average sale was certainly below 100,000. Speaking from memory, it was maybe in the $40,000 range, and that's gradually increased over time. Late March of this year, we announced what at that time was our largest project, which was one in kind of the broader New York City region. And since then, we've won other projects in that similar type of range. I think that it's naturally happening as we continue to build up our experience, our name in the market, also as the sector around us matures. So I expect that we'll continue to see that average project size continue to increase over the years to come.
And how did the economics change from small projects to large projects?
I know that there's a slide in our investor presentation that says something along the lines of, every project is kind of fundamentally the same in the aspect of, our top line is the revenue from the energy being generated and sold, and then we have a cost to build that project and a cost to finance and operate that project over time. In terms of the size of the project, there's certainly variability within that, but it's really for us and for our development team to structure the most valuable projects that we can, whether that project be on the smaller side or the larger side. I think that on the larger side, sometimes those projects might be a little less frothy than the smaller projects, just based on the dynamics of the market. Also, from time to time, like most of our backlog, as addressed right now, is what you probably refer to as sole source, or it's not a request for proposal. It's our development team meeting clients and signing agreements with those clients. But there are from time to time some requests for proposals. We won one with a local utility here in New York City a couple of years back, and on that basis, those projects can be a little bit more competitive, and the margins could be a little bit tighter in that regard. But that might be a little bit of a wishy-washy answer, but hopefully that's clear that it's sort of really in the dynamic of the market in terms of how that plays out. And it's not necessarily based on the size.
Does it make sense for UGE to partner with commercial real estate players?
Yeah, I think that you could say that, in most cases, our clients that we often think about as partners really are real estate players. I think that to that question about the size of our project, I think that the answer here is somewhat similar too. In New York City, we pride ourselves on developing what we believe was the first community solar project in this market about 3 years ago, just as that type of project became feasible here. And that was with a real estate client that was quite forward thinking. In the years since then, we've really broadened out our base of clients that we work with as it's become more, as we kind of go through that, the adoption curve, right, from the earliest adopters to the broader swath of companies out there. I say that because I think that to that question also about size of project, I think as we continue to grow, as we continue to see this market, our sector grow, we certainly will find ourselves working with larger and larger players on the real estate ownership side as well.
Help us to understand the rationale and process behind the recent project sale in New York that you just announced. Can we expect more such sales in the future?
Well, I think that from our perspective, it's a large part of it is optionality and being able to have that option. To be clear, the main goal of the overall company here, of course, is develop, build, own, operate projects, and so that's the focus. But we get contacted very frequently from various types of funds and other asset buyers that are interested in buying projects from us. While that's not the goal, it's nice to be able to have that optionality and so on. So, the sale recently, that was a nice proof of concept, and provided a nice bit of non-dilutive capital to the balance sheet as we continue to scale up the company. But we'll continue to be selective in that manner. I don't expect that would necessarily be a theme going forward.
What has been the capacity of your largest project? And do larger projects provide more gross margin?
Yeah, on the gross margin side of that, I'll refer to the answer I gave earlier, where I would say not necessarily. There's probably a slight correlation that gross margins would be higher on a smaller project, but it's not like a hard and fast rule. The largest project to date, right now, generally speaking, we see our overall range of target project sizes being, and I'm speaking in like nameplate capacity here, on the smaller side being about 250 kilowatts, and on the larger side being about 5 megawatts. Now, as a company, we're very much in like the distributed space, right? We're not looking to, we're clearly not residential, but we're also not a utility scale player. And so in that single digit megawatts, whether that be 5 or 8 or somewhere in that type of range, is where the distributed space usually taps out. But having said that, almost all of our clients are repeat clients in nature. And so it's also quite common for us to win, one portfolio with one real estate owner or what have you. So, hopefully that gives a good sense in terms of the types of size and scale that we find ourselves focusing on most right now.
And what's UGE's margin on recurring revenue?
Well, what we point to there, and I know Paul touched on this in the prepared remarks, but the year to date, the gross margin's been, I think it's 48%. We've been targeting having gross margins at about the 30% mark, and even adjusting for one-time factors, we've been above that. So that, yeah, and I think we talked a bit at a fairly high level there in the backlog conversation about how these projects play out, and so really on the recurring revenue. And the self-finance projects say the revenue really is recurring revenue. That's how it's playing out. So we'll stick to that guidance for now.
Okay, and once the existing backlog is deployed, how should we think about the company's revenue and potential EPS, assuming no further wins?
Well, I think a couple points. One is that we think about our backlog as being about a 2-year build out. And I think on the additional wins, I think we feel pretty confident that we'll continue to grow it over time, of course. But I get the point. So I think that in terms of well, just on the recurring revenue right now, let's say that we closed up shop, right? Aside from harvesting what we've built, I'm speaking. I don't want to misspeak when I'm speaking off the cuff here, but 11 million of recurring revenue. Our overhead has been in the sub $3 million type of range. Obviously, that the overhead would go down substantially if we weren't out there winning additional projects, and a gross margin of 30% or higher means that we'd be talking about that we'd be talking about well, I guess EBITDA in the range probably of $3 million or something like that. That's speaking directionally correct. But again, I don't want to go too far off the cuff here when I'm just doing mental math and get something wrong.
Okay, here's a few questions in one. Discuss your cash balance following the award exercise and project sale, and how would having more cash on the balance sheet help your business?
Well, I think if you look at our financials over really the last at least couple of years, if not longer, we've typically put capital to work when we've had it. We've typically had cash balance positions in sort of the low to mid 6-figure type of a range. Our Q3 number was also in that range at 140 USD. That was after, I mean, we did settle a $1.2 million line in Q3, and at a discount, of course. But like I said, we put capital work in good ways in that sense. So that's where it was on September 30th. Then since then, we sold that project for $700,000. We also have had the warrants and options coming in as the share price has performed well. So that's buffered up that cash position by at least a couple $100,000 as well.
Okay, and can your business run without the investment tax credits in the United States and other incentives?
Yeah, I mean, I think that I'll make two answers into that one question as well. So, to start with, the it can, like, the economics just continue to improve. Our U.S. market's been so strong this year in terms of growing our backlog. But if I just talk about the Philippines market as one example, there the cost of solar is just so much cheaper than the grid in a market like that, where there's no incentives whatsoever, and it just drastically undercuts the grid rates. In the U.S., many markets are below grid rates now too, without that tax credit. But of course, if the tax credit's there, you're going to take it. And as it's currently, and actually one point of clarification too, in terms of the tax credit, is that as it's currently written, it actually never goes away for the commercial space. It does for residential, but the commercial space goes to 10% in a couple of years and stays there. That said, obviously there was an election and a changeover in terms of the administration here, and we think that there's a very high likelihood of the tax credit being sweetened in one or more ways. It was the investment tax credit was originally introduced in the Bush administration, so we're going back in time, in the neighborhood of 15 years. I forget exactly what year it came in, and it's been highly successful and was at 30% for almost all of that before it started stepping down gradually here last year. And so we think that there's a good chance it could be up to 30% again, which would be an add in terms of our current backlog and the value that we retain from it, but then also in terms of the size and profitability of the market going forward. We also think that there's an option for the tax credit to be given a cash grant option. We'll just have to see, and we're certainly lobbying for that and hoping that that comes true. The real benefit to us in the commercial solar space really comes down to the speed and cost of monetizing the tax credit in the commercial space, as opposed to the utility scale space where the ticket sizes are just that much larger, that the institutional aspect of the tax equity market is quite a bit more robust. So in the commercial market and the chances of that happening, I would just add are further bolstered by the fact that this did happen after the financial crisis. So the sector's been lobbying for it. I think there's a good chance. Obviously, the incoming administration will want to be supportive in helping out this industry, and that would be nice as well. So, the question was, could we stand without the tax credit? And absolutely we can. But I also answered there our current company thoughts on what the evolution of that tax credit might look like.
How long is your sales cycle, and what can you do to shorten it?
Yeah, I think how long is the sales cycle? So there's a couple aspects to that, right? I mean, we had earlier this. Just going to flip back to it, but we have this. We have this slide here that talks about the different stages here. So a project, when we consider a project in development, at that point in time, we've already secured the project. We've already gone through what we consider the sales cycle. That sales cycle, led by our origination folks, can go slow or can go fast. And for our repeat clients, I'm thinking about some specific examples right now where it's really a matter of like, oh, we've bought a new building, and send us the paperwork, to a new client we haven't met before, where the conversations might stop for a year before we finally get to a point of saying, okay, let's go. That's on the development side. But once that project is confirmed, we then go into the more robust project development, which, there's different hoops that we jump through. This is where a good amount of our kind of secret sauce is about how we put these various pieces together to make a profitable project. Probably the high pole in the tent, so to speak, relates to working with the utilities on the grid interconnection approval process. And that can take 3 months to certainly over a year. On the utility scale side of things, that as I mentioned, we're not a player in, it can take a good couple of years or more. And so this question about how can we make it go faster, I think that I think that we are becoming more efficient over time. We continue to work better and better with utilities to understand the process, make that process as clean and as efficient as either side can make it. But I think in addition to that, the question goes to, I guess, working with our real estate clients to shorten the lead cycle as they see more and more these projects get built, and just becomes more and more normal in the sectors that we're in.
Is the pandemic inhibiting your ability to expand in existing and future regions?
My short answer is no. I mean, I think that we're all dealing with an interesting 2020, and so on. I think that we just thinking about the year as a whole here, when it first hit, we actually, I think it accelerated some of our sales cycles in the sense that we had some really good conversations ongoing, and those clients then felt quite compelled to move forward with the economic uncertainty. And keeping in mind, those clients are typically, the structure of these projects is that we're paying a lease for roof space, and so we're adding to their bottom line in moving forward. Obviously, when there were quite strict restrictions in late March, April, May, it did mean that going out and meeting new clients wasn't always as quick as it would have been. That said, we've had our best quarters in the company's history during this time frame. So, without the pandemic, the question might be how much more could we have done? Obviously, in that March, April, May timeframe, there was some pretty strict slowdowns in the greater New York area. We've seen those much in the rearview mirror now, and nowadays, even as the situation continues to be volatile, we found that construction is one of those sort of protected areas where we continue to motor forward, and we don't see any risks right now along the lines of that. Knock on wood. But we'll keep preparing for as many projects as we can for construction for next year, and continue to build out the backlog in that sense.
Can you provide us with an update on the developments and the opportunities in Maine?
Sure. Yeah. Maine is one of these markets that it didn't have a community solar market even as little as say a year ago. Someone on our team, Tyler, he's actually the one who had moved over and built up our Philippines market before that. But he had spotted the opportunity in New England broadly, but in Maine specifically, a couple years ago, and started planting seeds there, and sort of under wraps, developing that market to find some good opportunities. This year, the community solar market has really exploded as the regulations have allowed for it, and as UGE's been on the ground there and secured several projects ourselves. I know that the IR firm that we work with, Sophic Capital, they put together a summary in the last 10 days or so that talked about some comparable transactions, and there was actually a portfolio of pre-construction, or as this slide says here, development stage assets up there that Carlisle had acquired for, if I'm not mistaken, 130 million. So I mean, we were on the ground there early at the right time, spotting a good opportunity and developing a number of sites up there. So we're excited for that market. I'd be remiss not to say, New York community solar market opened up a few years back, Maine just in the last year, but there's pilot programs right now in markets like New Jersey and Connecticut, which of course are both very close to home here, and other markets that we have our eyes on as well. So, this is, I often say this when introducing someone to the story, but, just to touch on it briefly, the really exciting thing about community solar, and don't let that term confuse you in the sense that, like, the overall New York City area, including Westchester County, is considered a community for the sake of this market. So it's not just a small community, but what it allows us to do is it allows us to generate energy at one point of connection within this quote unquote community, and then provide the energy to other off-takers within that same community. And so it really opens up the size of the market based on the fact that under 10% of commercial tenants own their building. And so for us to be able to just go directly to those real estate owners provides us a much larger market to expand into. And so, I think that's a big part of the reason for the backlog growth this year.
Can you explain what a lockup is, why you're in one, how long before it expires, and how should investors be thinking about insider ownership and buy-in at UGE?
Yeah, I think so a lockup, just on that, UGE, when we downsized, or when we started to downsize the EPC services business unit in late 2018, it was a more challenging period for the company to go through, and we knew it was going to take some time. And not that we had wanted to sell shares before that, but as a sign of our commitment to the company, myself and our other largest shareholders, we all entered into a 3-year lockup to just show that commitment to everybody that, hey, we were not going to sell a single share. We were riding this out. And I don't remember the exact month, but I know it was a 3-year lockup, and so we still have a good amount of time left on that, and certainly we're all very committed to the cause here. And then, if I answer that question more broadly, we've had new board members join the company this year. If you follow like our insider transactions, we've all been very supportive in our own ways of the company this year, and continue to be, because we still feel that the company is quite undervalued just based on the value of our backlog right now. But also, I think more broadly, just very excited about the future of the company and where we're headed.
How can you accelerate the growth of your backlog, and what are the biggest risks to continuing the growth of your backlog as well?
Yeah, I mean, obviously, it's been growing pretty quickly this year, and so we're on the one hand proud and excited about that, but I think it may have been in the prepared remarks that I said a comment about our development team is probably hungrier now than they ever were before, because they just continue to see what's possible and the growing size of what's possible, and that just gets us excited. So I think that for us, it's some of the points that we talked about earlier, continuing to build up market awareness within our sector of what we're doing, and why it makes good sense for our real estate partners, and then it also growing our regional reach, and growing our development teams as well. So I think we have a very good platform, a very good model for this sector, for what we're doing. And we're not going to get too far out in front of our skis. We're going to be very focused on making sure that we do this right. But yeah, I that's the goal, is to continue to see ourselves grow at a good clip here.
Okay, there's a clarification question here. So the $111 million of remaining revenue or remaining value is the NPV through COD, and the upfront revenue is gross revenue through COD. Is that correct?
Yeah, and keep in mind, so the slide that's visible here, keep in mind that this is a combination of all the projects in our backlog, right? And so the upfront revenue, part of that, there's a smallish minority of the projects in our backlog are client financed. Now, more and more of our projects are UGE financed, the vast majority. I don't have the percentage off the top of my head. But there is some client finance projects. And so that is what we consider upfront revenue, in the sense that we're developing that project, we're building that project, but then the client's going to take it over at COD. And so in that sense, we count that upfront revenue being through that deployment phase. So I'll make that clarification comment first. But then also, in addition, in terms of upfront revenue, and there is, like, for example, sometimes there'll be a grant or something like that. In our Philippines market, some of the revenue is considered upfront, even in a situation where we're providing financing to it. So there's nuances like that. Now, Marcel, remind me if I missed part of that question.
Oh, sorry, I was on mute there. Yeah, so the other part of the question was upfront revenue is gross revenue through COD?
That's right. Yeah, upfront revenue, gross revenue, up to and including the point of COD.
Okay. Has UGE had difficulty attracting contractors to build your projects in the pandemic?
The short answer is no. No, I think we have some really good partnerships on the subcontractor side of things. We have really good project managers who are managing those relationships and so on. But yeah, I'm rattling my brain here just to think of if we've had any of those types of issues, COVID related. But no, I think that obviously people were pretty hungry coming out of the lockdown that we'd experienced in March, April, May, to earn some revenue themselves. And I think, yeah, no. So
why isn't UGE operating in sunny states like Florida and Arizona?
Well, for us, it's really a matter of growing from our areas of strength. The company was originally founded in New York, and so throughout the Northeast, that's been a really good market for us. If you look at the U.S. as a whole, there's actually a very significant percentage of all commercial buildings are actually in the Northeast U.S. So in terms of our clients that we work with, we start from a favorable position there. Also, the cost of electricity is quite high, especially in the New York City area. And so if we're, offsetting electricity prices, to have a high cost of, for our competitor there, that's helpful for our business model as well. Now, all that said, we look to continue to grow and expand as a company. I think there's a lot of markets that we can grow and expand to. So, I guess give us some time, but we'll continue to expand our boundaries over time.
How much of your business comes from landing a customer and expanding across their property portfolio?
Yeah, I don't have a specific percentage, but quite a bit. I think that close to all of our clients are repeat clients. And in many cases, they're already repeat clients, but in many other cases, those are preliminary conversations. They might not be in pipeline yet, but they're the types of real estate owners that own many buildings, and we look to expand throughout that portfolio. So, I know we announced 3 projects last week. One of those projects was a follow-on to a follow-on to a follow-on for a long-standing client of ours. The other one was 2 sites. Those 2 sites actually, it was 2 separate contract dates. The first one we signed, and then the second one came in pretty quick after. But we'll look to hopefully expand that relationship quite a bit over time as well. So, yeah, that's a bit of a qualitative answer instead of a quantitative one, but it's certainly significant.
Does your development business provide higher risk?
Well, I think that I think probably less so than you would think. I think that when we downsized that EPC services business, we ran into the risk of that business in 2018 when a few different things had happened. But for in our financial statements, you'd find there's a couple clients that hadn't paid that EPC services business in 2018 and beforehand that we're still trying to collect payments on. That would be upside when we hopefully do collect some payment on those. But as the EPC services provider, you do have the potential to get squished. I think that's a subline though. The more important point there is that as a developer, you're really in control. And I think actually this year, 2020, with the pandemic and so on, is a good case in point in that regard. As the restrictions lifted, we pretty much immediately got back to work on our sites, on building out the sites that we're the developer on. I mentioned earlier the client finance sites. Those ones took a lot longer for the clients to clear the path for us to move forward, based on it being on their timeline as opposed to our timeline. Obviously, there is a lot more reward in developing your own projects. And so, on that basis, we are the tall nail, so to speak, in that process. But yeah, I really don't think it's as black and white as to be able to say, oh, it's riskier if you're the developer, because I think there's a lot of reasons why it's certainly the preferred position to be in this sector.
Okay, we have time for one more question. It's one that you already touched upon. Outside of the ITC, can you talk about how the Biden administration could positively impact the solar industry and UGE's business?
Yeah, I mean, I think I'd say that our kind of our corporate wish list is the same now as it was going into the election. The first one is the investment tax credit extension, which would provide a nice extra boost in terms of future value of our backlog and size of the overall market and so on. The second one is a cash grant option for that, which we're cautiously optimistic. And I'll say that in both those cases, speaking at a level here, I mentioned earlier that the Bush administration is what had originally brought in the ITC. Also, in addition to that, the McConnell has passed, I think on at least 2 occasions, bills that included an ITC extension, only for Trump to nix it. So I think that there's a very high likelihood in this regard. So yeah, so for wish list of 3 items. The first one is the ITC extension. The second one relates to the cash grant or the direct pay, as it's sometimes referred to, and the is anyone who's followed the sector, or for that matter, maybe followed the company, might remember that in early 2018, there was something called the Trump tariffs that were introduced in the US. So punitive tariffs on importing solar equipment into the US. The sector as a whole, I don't want to speak for it, but I would say that the consensus has certainly been throughout that time period that they don't make sense, they're not helpful, but they make equipment in our space far more expensive than it needs to be. Speaking off the cuff, but easily 10%, probably quite a bit more in terms of like our cost of sales on these projects. And so the potential removal of those tariffs would be a nice win in terms of improving the economics of what we do as well, and including the current backlog, never mind additional backlog. So, that's our wish list. We're cautiously optimistic. I think that there's a lot of upside to that in terms of other types of initiatives around renewable energy and infrastructure and things like that as well. But we'll take that as it comes.
This concludes today's question and answer session. I will now turn the call over to Nick and Paul for their closing comments.
I just want to thank everyone again for tuning in today. We really appreciate it. Like we've mentioned, and I'll flip to the last slide. Oh, I'm not going to. But just to say real briefly that you can reach out at any time. You can also go to the Sophic Capital website there for more information, and really appreciate your interest today. So thanks again.
This concludes UGE's International third quarter of 2020 conference call. Thank you for joining us. Have a good day.